Crude oil prices have been under pressure lately, influenced by a mix of challenges from ongoing conflicts in the Middle East to shift in the global economy. Hi, I'm Jun, a researcher at Dxpert. Libya's oil industry has been thrown into chaos due to a standoff between the country's rival governments. The eastern government in Benghazi cut oil production over a dispute with the UN-backed government in Tripoli, which centers around who controls the central bank. As soon as the production halt was announced, oil price shot up past $80 per barrel. In response to the escalating situation, Libya's National Oil Corporation or NOC declared force majeure on the oil field. Now, this legal clause allows companies to stop fulfilling contracts due to circumstances beyond their control. Eastern authorities had shut down oil production and export as part of the dispute. Oil, which was producing around 70,000 barrels per day, is now offline, and Libya's overall output has been slashed by more than half. So, the Libyan central bank, which manages billions in oil revenues, lies at the center of the conflict. Eastern authorities initiated the shutdown after Tripoli's UN-recognized government replaced the central bank's governor, Sadiq Al-Kabir. Before the stoppage, Libya was producing around 1 million barrels per day, mostly from the eastern region, but that figure has now plummeted to roughly 450,000 barrels daily. Although Libya hosts Africa's largest proven oil reserve, its production has been repeatedly disrupted by political infighting since the 2011 ousting of dictator Muammar al-Gaddafi. Now, the good news is that on September 3rd, reports indicated that the two Libyan governments were nearing a deal to resume oil production after several days of disruption. However, the downside is that US crude oil prices fell by over 5%, hitting their lowest point since December due to the potential of renewed supply. Turning to China, the world's largest oil importer and second biggest consumer, the country is contributing to oil price pressure too, due to growing demand concerns. Recent data highlights a slowing Chinese economy, with the official Purchasing Managers Index or PMI for August falling to 49.1, which is a 6-month low and marking the 4th consecutive month of contraction. Additionally, the Producers Price Index for July dropped by 0.8%. indicating weaker industrial demand for oil. Meanwhile, Goldman Sachs recently forecasted a sharp slowdown in China's oil demand. However, this isn't solely driven by economic factors. A significant part of the decline comes from China's ongoing shift from oil to natural gas and electric vehicles. As a result, oil demand is expected to gradually decrease even though the slowdown isn't entirely tied to the economy. With China's domestic demand cooling, the country is turning to global markets to offload its surplus supply. This sets the stage for a potential oil product flood in Asia during the second half of 2024. Now, China has already issued 33 million metric tons of fuel export quotas in the first 5 months, which is a sharp 18% increase from last year, and rising concerns about oversupply and shrinking margins for Asian refiners. Despite this, China has only used 60% of its quota, exporting 19.9 million tons of gasoline, diesel, and jet fuel, marking a slight 2.6% drop compared to last year. As the domestic oil product surplus intensifies, all eyes are on Beijing, with the expectation that even more products will hit global markets in the coming months, potentially shaking up the oil market. Moving over to the charts, a look at the WTI crude oil price on monthly time frame shows that the $66 range may act as a potential support level, while the resistance may be at around $82.5. With the influence of supply and demand dynamics, along with OPEC Plus plans to increase production, this could continue to keep oil prices under pressure. I hope today's video has been helpful. Thanks for tuning in. Everything I've shared comes from a mix of research and my own perspective. Remember, when it comes to trading or investing, always do your own due diligence and stay aware of the risks. If you enjoyed this video and found it helpful, please subscribe, share, and hit the like button. You can quickly access to all our channels by scanning the QR code. Take care, and I'll catch you in the next episode.